Silver hit $121. Then everything fell apart. 6.5%. Crash explained. Silver hit 121. Charts went vertical. Confidence followed, and for a brief moment it felt like the market had finally lost all gravity. Then everything fell apart. In a single session, prices reversed hard. Billions shifted position, and what looked like certainty turned into confusion almost instantly. But this was never just about silver. It was about pressure building beneath the entire financial system, and silver simply moved first. Stay with this, because what caused this move is not obvious at first glance, and by the time most people understand it, the opportunity is already gone. Welcome to Boring Currency Index, where markets are not explained as entertainment, but as warnings. Silver's rise to 121 did not happen by accident. It followed a familiar historical pattern. When markets accelerate too quickly, time itself becomes compressed. Gains that normally take years appear in weeks. That speed creates belief. Belief creates crowd behavior. And crowd behavior creates fragility. Parabolic moves feel strongest at the top. Volatility is mistaken for momentum. Risk is ignored because recent success feels like proof. This is how late capital enters markets. Not because fundamentals suddenly improved, but because price action overwhelmed caution. Silver responded more violently than most assets because of its nature. It is smaller than gold, easier to move, and more sensitive to leverage. It also carries a dual role. It is both a monetary hedge and an industrial input. That combination amplifies every move. When confidence rises, silver surges. When pressure appears, silver reacts first. Hey everyone, let's talk about something that can feel a little scary in the world of investing. Market volatility and corrections. So what exactly are they? Think of the stock market like a roller coaster. It has its ups and downs. Volatility is just a measure of how big and frequent those ups and downs are. A high volatility market means prices are swinging wildly, while a low volatility market is much calmer. Now, a market correction is when the market drops by at least 10% from its recent high. It sounds alarming, but here's the key. Corrections are a normal and healthy part of the market cycle. They help to reset valuations and can even create buying opportunities for long-term investors. Instead of panicking, it's important to remember your investment strategy and stay focused on your goals. They don't last forever. Hope this helps clear things up. If you found this useful, don't forget to like and subscribe for more. See you next time. Hey everyone, ever wonder where to put your money when the markets get shaky? Let's talk about gold and silver. Gold is like that reliable, steady friend. It's known for its stability and has been a safe haven asset for centuries. When you see the US dollar starting to weaken or inflation creeping up, investors often rush to gold because it holds its value really well. It's the classic move for protecting your wealth. Now, silver is a bit different. Think of it as gold's more exciting, volatile cousin. Its price can swing up and down more dramatically because it has huge industrial demand in things like solar panels and electronics. So while silver offers the potential for higher returns, it also comes with more risk. So, are you looking for stability or a bit more thrill in your portfolio? Understanding the difference between gold and silver is key. Thanks for watching, and don't forget to subscribe for more insights. Did you notice the tension building in the global markets lately? Beyond just currencies, bond markets everywhere, from Japan to the United States, are showing serious signs of strain. Long-term government debt, once seen as the ultimate safe investment, is starting to look risky as yields spike and servicing costs become a real concern. So, if currencies are losing value and bonds are unstable, where do smart investors put their capital? The answer has been gold. Its steady climb, even when silver took a volatile dip, shows this isn't just speculation, it's a strategic move into hard assets. Silver's wild swings actually confirm this trend. It's the first to react. But gold's calm, steady rise is the real signal. It tells us that defensive capital is finding its final destination. Gold's strength is a clear warning that trust in our traditional financial systems is fading. The system is under strain, and capital is moving to safety. Thanks for watching, and don't forget to subscribe for more insights. The sudden fall in silver looked dramatic, but it was not mysterious, it was mechanical. Markets often move sharply, not because beliefs change, but because positions do. This drop was a lesson in how modern financial systems behave when prices move too far, too fast. After silver surged more than 50% in a short period, many investors were sitting on large unrealized gains. When the price reached new highs, some of them chose to lock those gains in. This was not fear, it was discipline. Large funds, traders, and institutions are trained to reduce exposure after extreme moves. Once selling began, the price lost momentum. That initial selling triggered the next layer of pressure. Many silver positions were built using leverage. Leverage magnifies gains, but it also magnifies losses. When prices began to fall, leverage traders faced margin requirements. To stay in their positions, they had to add more capital. Some could not. Others chose not to. They sold. At the same time, the exchange took action. The CME Group raised margin requirements on silver contracts. This is a standard response to high volatility. When margins rise, traders must post more collateral to hold the same position. For many participants, the easiest response is to reduce exposure. This forced selling added to the downward move. Another important factor came from China. Domestic silver investment funds paused trading after premiums rose too far above global prices. These pauses are designed to protect investors from buying at inflated levels, but they also remove a major source of demand, even if only temporarily. When that buying disappeared, the market felt the absence immediately. None of these events reflected a change in silver's long-term value. They reflected stress inside the trading system. When too many positions are aligned in the same direction, small shifts create large reactions. Liquidity dries up, prices gap lower, volatility increases. Silver has a long history of this behavior. It is smaller than gold and easier to move. That makes it attractive during rallies and dangerous during corrections. It often leads both up and down. This is why experienced investors treat silver differently. They expect violence in both directions. It is important to understand what did not happen. There was no sudden improvement in global finances. There was no resolution to geopolitical risks. There was no policy shift that reduced the need for hedges. The story did not break, the structure did. Corrections like this serve a purpose. They remove weak hands. They reduce leverage. They reset expectations. Without them, trends become unstable. What looked like a crash was, in reality, a pressure release. The silver market did not fail. It adjusted. And those adjustments often feel worst at the moment they are most necessary. When the market noise dies down, the big question isn't how much silver's price dropped, but what's fundamentally changed. And honestly, not much. The reasons why people are turning to precious metals are stronger than ever. Global debt is still climbing faster than our economies are growing. Governments are borrowing more and more, and people are starting to wonder if they can ever pay it back. This puts a ton of pressure on currencies. When money is being created out of thin air, smart investors look for real assets that can't just be printed. That's where gold and silver come in. They exist outside of that system. Plus, the whole global financial system is shifting. Trade is changing. Supply chains are messy, and political ties are shaky. All this creates uncertainty, and uncertainty is a friend to precious metals. Central banks are stuck too. They can't raise rates without hurting growth, and they can't cut them without sparking more inflation. In times like these, assets that don't depend on government decisions just make sense. Thanks for watching, and don't forget to subscribe for more insights. Gold reflects this reality clearly, but silver follows closely behind. Silver's industrial demand continues to rise. Renewable energy, electronics, and electrification require large amounts of it. Supply, however, remains constrained. New mines take years to develop. Recycling cannot expand quickly. This imbalance supports prices over time, even if short-term moves are unstable. Geopolitical risk also remains elevated. Conflicts, trade disputes, and diplomatic tensions continue to influence markets. These risks do not disappear overnight. Each escalation adds to uncertainty. Each period of calm remains fragile. In such an environment, defensive positioning becomes logical, not emotional. The recent pullback did not erase these conditions. It simply reminded investors of silver's nature. It is not a smooth asset. It rewards patience and discipline, not impulse. Those who confuse volatility with weakness often exit at the wrong moment. For long-term observers, the message is clear. The trend is being tested, not broken. Corrections are part of that process. They separate conviction from speculation. The market's role is not to provide comfort. It is to challenge assumptions. In this case, the challenge revealed that despite sharp moves and alarming headlines, the forces driving interest in precious metals remain intact. Stability may look convincing on the surface, but pressure continues to build underneath. And markets have a way of revealing that pressure when it matters most.